There is a question that comes up constantly in the Dividend desk community whenever we cover NEOS funds. The question is not, what do these funds do? The prospectus covers that. The question is, how do you actually think about them? How does the team at NEOS decide how aggressively to write calls each month? What is the real plan when volatility drops and premiums compress? When NAV comes under pressure during a downturn, what is the strategy? And critically, are these products genuinely built to generate income for the long run, or are they designed to look great in the specific market conditions of the past 2 years? Those are hard questions. They deserve direct answers from the people actually making these decisions. So today on Dividend Desk, we are going directly to the source. We are joined by a senior managing director and head of investment strategy at NEOS Investments, one of the fastest growing and most discussed ETF issuers in the income space today. We are going to cover the 4 strategic buckets that define the NEOS product suite, go deep on how they think about NAV, address the 2 most common investor concerns directly, and talk about the future of covered call investing. Let us get into it. Welcome to Dividend Desk. For anyone who is new here, we cover income ETFs, covered call strategies, and dividend portfolio construction with the kind of analytical depth most channels skip. Today we have someone who deserves a proper introduction. He is a senior managing director and head of investment strategy at NEOS Investments, a firm that in just over 3 years has built one of the most talked about ETF suites in the income investing community. NEOS runs funds you have almost certainly heard about if you spend any time in the covered call space: SPYI, QQQI, IWMI, BTCI, and a growing lineup of additional strategies. Welcome to the show.
Great to be here. Really appreciate the opportunity to connect with your audience directly. These are exactly the kinds of conversations we want to be having with investors.
Before we get into the specifics of the fund lineup, I want to give our audience the origin story, because I think it matters for understanding why NEOS approaches product design the way it does. Walk us through where the firm came from and what problem you were originally trying to solve.
Sure, NEOS is a little over 3 years old at this point, but the experience that the founders brought into building it is considerably older than that. Our 2 co-founders, Troy and Garrett, were actually part of the original team that created some of the first covered call ETFs back in 2013. So when we talk about the evolution of this space, they were literally at the beginning of it. What NEOS represents is a newer iteration built on everything that was learned in that earlier era, specifically what worked, what did not work, and what could be done meaningfully better. The problems they saw with the first generation of covered call products were fairly consistent: full notional coverage that capped all the upside, income that was not always sustainable across different volatility environments, and tax structures that were not designed with the retail taxable investor in mind. NEOS was built from the ground up to address all 3 of those issues simultaneously. We want to generate high income, but we want to do it in a way that is tax efficient where possible, that preserves NAV over time rather than eroding it, and that delivers consistent enough distributions that investors can actually plan around them. Those are the 3 design principles that drive everything we build.
That is a perfect setup for what I want to explore in depth today. NEOS has organized its suite into 4 distinct strategic buckets: high equity income, boosted high income alternatives, and hedged equity income. Before we go deep on each one, give us the 10,000-foot view of what problem each bucket is actually solving for an investor.
Sure. So at the highest level, what we are recognizing is that there is no single income product that is right for every investor in every situation. Different investors have different risk tolerances, different tax situations, different income requirements, and different views on what trade-offs they are willing to make. The 4 buckets are our attempt to give allocators genuine choices along that spectrum rather than a one-size-fits-all approach. The high equity income suite is the core. These are our flagship index-based covered call funds: S&P 500, NASDAQ 100, Russell 2000, and similar, where we are writing options on top of an equity index exposure to generate a meaningful monthly distribution, typically targeting 10 to 15% depending on the underlying. while trying to maintain some NAV growth potential. That is the foundational offering for someone who wants equity exposure with an income layer on top. The boosted suite is for investors who said to us, "I like what you are doing with the core products, but I want more income potential, more upside participation." Those products target approximately 150% of the exposure of the equivalent core fund, so about 50% additional notional exposure, which means 50% more targeted income, but also 50% more participation in both the upside and the downside. It is a higher octane version of the same underlying philosophy. The high income alternatives bucket is where we started looking beyond equities entirely. The question there was, what asset classes do not normally generate income, but have the volatility profile that makes writing options against them very productive? Bitcoin and gold were the obvious answers. Bitcoin has some of the highest implied volatility of any liquid asset in the market. Gold has had elevated volatility for the past year, driven by geopolitical factors and central bank demand. Writing covered calls against those assets in a structured way can generate extraordinary income levels. Our target on Bitcoin products is 27 to 30% annually. That simply cannot be achieved on lower volatility equity indices. And finally, the hedged equity suite is for investors who want income but are genuinely concerned about left tail risk. They want some explicit downside protection built into the fund rather than relying entirely on the income buffer that covered calls provide. Those funds exchange a portion of the distribution target for the purchase of put spreads that activate in major market downturns.
Let me push on the high equity income side specifically, because that is where most of the investor conversation centers. When you are managing a fund like SPYI or QQQI, the core decision you are making every month is how aggressively to write the calls. How much notional coverage, how far out of the money, what strike levels. Walk us through how that decision actually gets made.
It is one of the more nuanced parts of what we do. And honestly, one of the things I think distinguishes our approach from some of the more mechanical strategies in this space. The decision framework starts with a fundamental question. What is the worst-case volatility scenario for this underlying index, and what level of distribution can we sustainably deliver even in that worst case? We do not want to set a distribution target that only works when volatility is elevated. We want something that we believe we can deliver across the full range of market conditions we could realistically encounter. For the S&P 500, we are currently at approximately 55% covered notional. That means 45% of the portfolio has full uncapped upside participation. In a higher volatility environment, we can collect enough premium from writing calls on 55% of the portfolio to meet our distribution target. In a lower volatility environment, premiums across the curve compress, and we might need to go to 70, 75, or even 80% covered to generate the same income, which means giving up more of the upside potential. That dynamic is inherent to the strategy. What we try to do is set our distribution targets at a level where even if we have to increase coverage to maintain income in a low vol environment, we are not going fully covered and completely eliminating upside. We never want to be at 100% coverage. That is a design principle, not just a preference. Full coverage means the only return investors get beyond the distribution is from any income above the strike price if the index stays flat, and over long periods, capping all the upside while still capturing all the downside is not a trade-off that works in investors' favor. The art is finding the right balance for each index based on its natural volatility characteristics.
That brings up the question that generates more comments on income investing content than almost any other topic, which is NAV erosion. We actually collected two specific questions from our audience that I want to put directly to you. The first is, are these funds genuinely designed to pay forever with zero NAV erosion? And the second, from a viewer who was more skeptical, was, anything paying more than 15 to 17% requires accepting severe NAV erosion in flat or down markets. How do you respond to both of those?
Both are fair questions, and I appreciate the directness because these are conversations we need to be having. Let me take the first one first. Are these funds designed to pay forever with zero NAV erosion? The honest answer is there is no free lunch in any investment strategy. These funds will follow the underlying market they are tied to. If the S&P 500 drops 50%, our S&P-based funds will also drop. Perhaps not the full 50% because our partial coverage and the income distributions act as a cushion, but we will be down significantly. Anyone who tells you otherwise is misrepresenting how covered call strategies work. What we are trying to build is not a product with a floor at zero or a guarantee of permanent NAV stability. What we are trying to build is a product where over time, measured in years, not months, you are participating in some of the underlying's price appreciation while generating substantial income that meaningfully improves your total return relative to holding the index alone. The distributions reduce the net loss in down markets. The partial uncovered exposure allows a NAV recovery in up markets. Over a full market cycle, that combination should result in NAV that is broadly maintained or modestly growing, not continuously eroding. But in any single down year, yes, NAV will decline with the market. That is the reality, and we are transparent about it. For the second comment about 15 to 17% being inherently unsustainable, I would say that framing applies to some products in this space, but is not universally true. Sustainability of a distribution target depends entirely on the natural volatility of the underlying asset. For our S&P 500 products, our distribution target is 10 to 12%. We believe that is sustainable across virtually all historical S&P volatility environments based on our analysis. For our Bitcoin products, our target is 27 to 30%. That sounds dramatic until you understand that Bitcoin's implied volatility, even in historically low periods, is dramatically higher than the S&P 500's implied volatility in its highest periods. The premiums available from writing Bitcoin options are genuinely large enough to sustain that distribution without over-distributing. So 15 to 17% for an S&P 500 product, I would agree that probably requires accepting some NAV erosion in tough conditions. But 27 to 30% for a Bitcoin product is a different conversation entirely, driven by a completely different volatility profile.
Let me stay on that tax efficiency point, because it is one of the things that genuinely differentiates NEOS from a number of its peers, and I want our audience to understand exactly what it means in practice. When you write options against the index itself, using NDX or SPX options, those are treated as Section 1256 contracts. Can you explain what that means in real terms for an investor holding these funds in a taxable account?
Sure. Section 1256 is a specific provision in the U.S. tax code that applies to certain exchange-traded contracts, including broad-based index options like SPX and NDX. The provision specifies that 60% of the gains from those contracts are automatically treated as long-term capital gains and 40% as short-term capital gains, regardless of how long the position was held. Normally, options that are held for less than a year are taxed as short-term gains at ordinary income rates, which for most investors in meaningful income brackets means 22, 24, 32, or even 37%. The 60-40 split changes that calculation substantially. For someone in the 32% bracket, for example, instead of paying 32% on 100% of the option's income, they are paying 20% on 60% and 32% on 40%. That blended rate comes out around 25%, meaningfully lower than 32% straight ordinary income. Over years of distributions, that difference compounds into real money. We also benefit from the fact that the equity portion of our portfolios generates qualified dividends, which are taxed at the lower long-term capital gains rate. And our portfolio management approach allows us to engage in tax loss harvesting within the fund, strategically realizing losses against gains to generate return of capital distributions, which are not taxed in the year received and instead reduce the investor's cost basis. That defers the tax obligation until they eventually sell the fund shares, at which point the gain would likely qualify for long-term capital gains treatment. These structural tax advantages were consciously built into our fund design because we recognized early on that most of our investors are holding in taxable brokerage accounts, not in retirement vehicles where tax treatment is irrelevant. An institutional endowment does not pay taxes and does not care whether income is ordinary or long-term. A retail investor paying 32% marginal rates cares enormously.
Let us move to the boosted suite because it tends to generate genuine confusion. When investors hear the word boosted, their first instinct is often leveraged in the traditional sense, borrowing to amplify returns. That is not quite what is happening here. What specifically is being boosted, and what does the risk profile look like relative to the core products?
It is a fair point that the terminology can be misleading. The boosted products are targeting approximately 150% notional exposure to the underlying index. So if the underlying is the S&P 500, instead of one-for-one participation in the S&P 500's price movements, you are getting roughly 1.5 times participation. That is achieved through option structures rather than traditional debt-based leverage, which has different risk characteristics, particularly around forced liquidation risk that traditional leverage carries. The income target in the boosted products is correspondingly higher, approximately 50% more distribution than the equivalent core product. If SPYI is targeting 10 to 12%, the boosted S&P version is targeting approximately 15 to 18%. The trade-off is straightforward. If the market goes up, you benefit from 150% of that upside. If the market goes down, you experience 150% of that downside. There is no mechanism in the structure that protects you on the downside more than the distribution income buffer provides. Historically, major equity indices have been positive in roughly 8 or 9 out of 10 calendar years. The boosted suite is built on the observation that in those positive years, capturing 150% of the upside while also generating substantially more income is a compelling outcome for investors who have an appropriate risk tolerance and who are sizing this product correctly within their overall portfolio. The important framing is that the boosted products are not a replacement for the core suite. They are an addition to it for investors who want to allocate a portion of their portfolio to higher octane income generation while maintaining a more conservative foundation with the core products.
I want to give the Bitcoin and alternatives conversation the time it deserves, because this is where the most skepticism lives in our audience. A lot of investors in the income space came here specifically for dividends and covered call equity strategies. They did not expect their covered call ETF issuer to be building products around Bitcoin. Make the case for why a fund like BTCI belongs in a conversation about income generation.
It is an interesting case to make, and I understand the instinct to be skeptical. Bitcoin does not pay dividends. It does not have earnings. It does not generate cash flow in any traditional sense. And yet it may be the single most income-productive underlying asset available for a covered call strategy right now, for one specific reason: volatility. Bitcoin's implied volatility is extraordinarily high relative to any traditional equity index. Even in historically low periods for Bitcoin's volatility, the implied volatility is well above what the S&P 500 experiences in its highest periods. Option premiums are priced on volatility. More volatility means more uncertainty. More uncertainty means option buyers are willing to pay significantly more for the protection that options provide. And that elevated premium is what the fund collects and distributes to investors. Our distribution target on BTCI is 27 to 30% annually, and that is not set arbitrarily. It is set based on analysis of what we believe we can sustainably generate even in the lowest volatility environments Bitcoin has historically experienced, while still maintaining meaningful uncovered upside exposure, so investors can participate in Bitcoin's price appreciation. The use cases we hear from allocators are genuinely varied. Some investors use BTCI for pure income. They want the high monthly distribution, and they see the Bitcoin price exposure as acceptable risk for that return. Some use it as a Bitcoin hedge. They hold Bitcoin elsewhere in their portfolio and use BTCI as a way to generate income from that exposure that can cushion potential drawdowns. Some reinvest the distributions back into the fund to compound their Bitcoin exposure at a higher than Bitcoin rate. None of those approaches is universally correct. It depends entirely on the individual investor's portfolio construction and risk tolerance. What we can say is that the mechanics are sound. The income is genuinely being generated from real option premiums on a real underlying asset, not from returning capital.
Let us talk about the hedged equity suite because I think it is the most underappreciated part of your lineup. The core products give you income with market participation. The boosted suite gives you more of both. Bitcoin gives you alternative income, but the hedged suite is doing something structurally different. It is using income to purchase explicit downside protection. Explain how that works mechanically and who it is actually for.
Hedged equity was designed for a specific investor profile that we were hearing from consistently. People who were genuinely interested in staying invested in equities and collecting meaningful income, but who were nervous about the level of equity risk they were taking on, particularly in a market environment where valuations are stretched and the macro outlook is uncertain. If you just hold the S&P 500 right now, your dividend yield is roughly 1%. That is essentially nothing in terms of income. If you hold one of our core high equity income products like SPYI, you are getting approximately 10 to 12% distribution. That is a significant improvement. But the hedged equity suite says, what if we take a portion of that 10 to 12% distribution budget and use it instead to purchase put spreads that provide explicit downside protection? The result is a fund that might distribute 7 to 9% annually rather than 10 to 12%, but that also has a put spread in place that activates if the market falls significantly in any given month. The protection is not designed to cover the first 1 or 2% of losses. Most investors are not genuinely concerned about that level of drawdown. It is designed to provide meaningful cushioning in those major left tail events, the 10, 15, 20% in a single month scenarios that genuinely threaten retirement portfolios and force investors into panic selling at exactly the wrong time. By spending some of the income budget on protection, the fund accepts a lower headline distribution in exchange for a meaningful reduction in extreme downside risk. For investors who are close to or in retirement and genuinely cannot afford a major drawdown event, where recovering from a 30% portfolio loss over the remaining years of their investment horizon is not really possible. That trade-off can be enormously valuable. The peace of mind alone may justify the lower yield. And importantly, you are still generating substantially more income than holding the underlying index by itself.
I want to close with the question I think is most important for long-term investors who are considering making these products a significant part of their income strategy. The covered call ETF space has existed in something like its current form for about 3 years. Every fund in this space has had favorable tailwinds, elevated volatility, elevated rates, and a tech-driven bull market. None of these funds have been tested through a prolonged bear market or a sustained low volatility environment of the kind we saw in 2016 or 2017. How does NEOS think about that uncertainty? And what should investors understand about how the product suite will behave if and when those conditions change?
It is probably the most important question we get asked and the most honest one. You are right that the environment of the past 3 years has been, in many respects, a favorable one for income strategies. Elevated volatility has meant larger premiums. Higher rates have meant more value in the treasury income that underlies some of our alternative strategies. A generally positive equity market has meant our partial uncovered exposure has worked in investors' favor. None of those conditions are permanent. What gives us confidence, not certainty, but confidence, that our products will continue to perform their stated function through different conditions is the analysis and back testing we did before bringing these strategies to market and the systematic way the portfolios are managed. When we set our distribution targets, we specifically looked at low volatility historical environments and asked, what can we sustainably distribute when premiums are compressed? We designed to that floor, not to the current favorable environment. That means in a sustained low volatility period, distributions may not be as high as they are right now, but they should still be materially positive and meaningfully above what investors would receive from just holding the underlying index. In a sustained bear market, NAV will decline with the market. That is unavoidable, and we do not try to pretend otherwise. What our products offer in that environment is a partial cushion through the distribution income and, for the hedged products, explicit downside protection. What they offer in the eventual recovery is uncovered upside participation that allows NAV to recover. That recovery potential is why we insist on never being fully covered. It is not just about capturing upside in bull markets. It is about building in the recovery mechanism for the inevitable down cycles that follow. The investors who will benefit most from our products over a full market cycle are those who understand that trade-off going in and who size these positions appropriately within a broader portfolio rather than concentrating entirely in high-yield income strategies.
That is exactly the kind of transparency that I think is missing from a lot of coverage of this space, and one of the reasons conversations like this one matter. Before we close, is there anything about how you see the income ETF landscape evolving over the next few years that you want investors to be thinking about?
I would say the most important trend to watch is the continued expansion of what assets can be used as the basis for income strategies. 3 years ago, covered call ETFs were almost entirely S&P 500 and NASDAQ 100 products. Today, we have products based on gold, Bitcoin, Ethereum, MLPs, fixed income, and a range of other underlyings. That expansion is going to continue. As new asset classes develop liquid options markets with meaningful implied volatility, the ability to generate income from them follows. The second trend I would watch is the sophistication of the income generation itself, moving away from simple at-the-money full coverage strategies toward the kind of adaptive, partially covered approaches that balance income with NAV growth and tax efficiency. Investors are becoming more sophisticated about distinguishing between funds that are genuinely earning their distributions and those that are paying yield at the expense of capital. That growing investor sophistication is forcing better product design across the industry, which is ultimately good for everyone. And the third thing I would watch is the increasingly important role that tax structure plays in fund selection. As the investor base for these products matures and more people hold them in taxable accounts for longer periods, the after-tax return differences between funds with different structures will become more and more apparent. Funds that were designed with tax efficiency as a core consideration, not an afterthought, will increasingly show their advantage. That is something we are very focused on at NEOS, and something we think will increasingly separate the durable products from those that looked attractive in the short term.
This has been exactly the kind of direct, substantive conversation that the Dividend Desk audience deserves and cannot get from a standard product overview. Thank you for taking the time to break all of this down so clearly and honestly. My pleasure. We welcome this kind of dialogue. The feedback we get from investors and allocators is genuinely how we build and improve our products. If viewers have questions or ideas after watching this, we are listening. That is not just marketing. It is how we have built everything from SPYI to our Bitcoin and Ethereum products. We heard from allocators that they wanted those exposures. We built them. The same openness applies going forward. To everyone watching, drop your questions in the comments below. No question about covered call ETFs is too basic or too advanced for this channel. The most common questions will drive future videos, and we are committed to continuing to bring the fund managers and portfolio professionals directly to you, rather than just talking about their products from the outside. If this conversation gave you a clearer picture of how NEOS thinks about income, NAV, tax efficiency, and portfolio construction, hit the like button and subscribe to Dividend Desk. New content every week. I will see you in the next one.